Everybody's celebrating. The stock market's up, tech is high-fiving itself. Nvidia just printed $57 billion in a single quarter, and the whole industry is acting like the future is solved. But that's not what this earnings report actually said. It didn't say Nvidia is great. It said Nvidia is transforming. It said the race is over, and they're the ones writing the rules. If you're still asking whether Nvidia is overvalued, you're already behind. The only question that matters is whether you understand what Nvidia is turning into, and what it'll cost you if you don't. This isn't a chip maker, it's becoming the AWS of AI, the infrastructure layer for a new kind of internet, and once it's in, it doesn't come out. Almost everyone thinks they missed it. That's what makes this so dangerous, because missing a breakout is annoying, but missing a monopoly while it's still being built, that's how people stay broke for decades. The price has moved. The window hasn't closed, but it's closing faster than people think, and that's what really showed up in this earnings report. Nvidia reported $57 billion in quarterly revenue. That's up 22% from last quarter and 62% from a year ago. Most companies would be happy doing that in a year. Nvidia just did it in 90 days. But the $57 billion isn't the impressive part. It's the warning shot, because numbers like that don't come from selling a better product. They come from controlling the entire market. Data center revenue, their most important segment, grew to $51.2 billion. That's 90% of their total revenue. Just one segment, scaling faster than every legacy chip maker combined. You know what else grew? Operating income, net income, free cash flow, up across the board, and not by a little. Margin stayed in the mid-70s. Net income topped $31.9 billion. And they threw off $22.1 billion in free cash flow in one quarter. Most companies can't survive scaling that fast. Nvidia isn't surviving, it's accelerating. That tells you something about the engine underneath this business. It's not overheating, it's built for speed. Everyone's looking at the scoreboard. What they should be looking at is how fast it's changing. This wasn't just a big quarter, it was proof that the machine is working at scale and nothing is slowing it down. Many people still think that Nvidia sells chips. That's old thinking. Blackwell changed everything. This isn't a product launch, it's a platform shift, and it's happening faster than anyone expected. The new Blackwell GPUs are already shipping to hyperscalers. Demand is so far ahead of supply, Nvidia said every cloud partner is sold out. That includes Microsoft, Google, Amazon, Oracle, Meta, even OpenAI. They're all locked in. Blackwell isn't a chip, it's a trap. Once you're inside, you're staying inside. It connects to NVLink, to Spectrum-X networking, to CUDA software, to NeMo microservices. It's a full stack takeover. Nvidia used to sell hardware. Now they sell infrastructure. And they're doing it the way AWS did with cloud. System by system, layer by layer, until switching costs become a death sentence. You can't swap Blackwell out. You can't just throw in an AMD card and hope it works. The entire ecosystem is vertically integrated. That's why networking revenue exploded 162% year over year. That's why data center growth hit 66%. Everything is scaling together while competitors are still struggling to ship. This isn't about who has the best chip, it's about who controls the environment. And Nvidia didn't just move into that space, they locked the door behind them. Most people think that Nvidia's price run is already priced in, that Blackwell explains the valuation, that all the growth is already on the table. But that assumption ignores one thing. They're not done. Nvidia is already building Romine, the next generation platform launching in 2026. It's not a concept, it's not vaporware, it's already in development, with the goal of making Blackwell look small. Blackwell was the shift, Romine is the multiplier. And if Romine lands with even half the impact Blackwell just had, Nvidia doesn't just keep growing, it compounds. Revenue doesn't spike, it stacks. Customer contracts don't reset, they expand. And every buyer who's already locked in, hyperscalers, cloud providers, sovereign AI funds, has a reason to buy more. This is how monopolies scale, not in one cycle, but across architectures. Romine isn't a roadmap item, it's a moat in progress. It keeps Nvidia a full generation ahead while competitors are still trying to ship Blackwell-class alternatives. If you think this stock is expensive, ask yourself, what if it's still early? Because this isn't a peak, it's a staircase, and the next step's already built. Let's talk about the real margin story everyone missed. Most people look at revenue, smart people look at margin, but almost everyone misread what just happened in this earnings report. Here's what they saw. Gross margins drop slightly year over year, so they start saying things like pricing pressure or cost headwinds. Here's what actually happened. Nvidia's margins expanded quarter over quarter while scaling up a brand new platform. That's not weakness, that's precision. Gross margin came in at 73.6%. Operating margin, 66.1%. Free cash flow margin, 43.6%. These are numbers most businesses will never touch in their lifetime, and Nvidia delivered them while rolling out the most important product cycle in its history. Why does that matter? Because it tells you two things. Number one, Blackwell isn't eating margin. It's already profitable at scale. And number two, this company has leverage built into every layer: product pricing, operations, and infrastructure. Last quarter, they generated $13.4 billion in free cash flow. This quarter, $22.1 billion. That's not optimization. It's a signal they're scaling without friction. So while analysts misread a 1-point shift in gross margin, they're missing the deeper signal. Nvidia is extracting more actual profit from its operations than ever before. Weak companies protect margins. Strong companies scale through them. Nvidia's doing it in real time, and most people still don't get what it really means. Let's talk contracts, the cloud, and why Wall Street is wrong. Wall Street cheered the report. The stock spiked, up 5% after hours. The reaction was expected. The interpretation was shallow because they're pricing in momentum. What they're not pricing in is permanence. This report didn't just show growth, it showed commitment. Nvidia isn't winning new business, they're locking in long-term control. The top hyperscalers already sold out of Blackwell. Infrastructure, budget, and roadmaps are now tied to this platform. Meta, Microsoft, Amazon, Google, Oracle, every major cloud player is already embedded, committed, scaling. This isn't a GPU purchase, it's an infrastructure rollout across networking, software, and systems. Even sovereign AI customers, entire nations are buying in. If you're building your own models, infrastructure, and sovereign AI capabilities, there's only one supplier positioned to deliver it all. And Wall Street is still treating this like a cycle. That's the blind spot. You don't get repeatable 20% plus quarterly growth from hype. You get it from contracts, from backlog, from visibility, and from systems. And from systems your customers can't replace without rebuilding their entire stack from scratch. The market is pricing Nvidia like a growth stock. They're wrong. This is infrastructure. Most people talk about moats like there's some long-term theoretical advantage, a brand, some IP, maybe a network effect. All vague, all fragile. Nvidia's moat doesn't live in theory, it lives in infrastructure. It's built into the execution, into switching costs so brutal that walking away means ripping out your stack and starting over from zero. This earnings report proved it's already working. CUDA still owns the AI developer market. Blackwell is embedded across every hyperscaler. NVLink, SpectrumX, NeMo, DGX Cloud. This isn't a product suite. It's an enterprise prison wrapped in premium pricing. And before your cheap ass starts crying about Nvidia being too expensive, let's do some math. You want a value play? Cool. Go scoop up some junk AI stock trading at 12 times earnings. Or better yet, go throw your money at a high-growth name that isn't even profitable yet. No moat, no infrastructure, no future. Then sit back while Nvidia drops $22 billion in free cash flow on your head in a single quarter. You saved money on valuation and gave up a monopoly in motion. Congratulations, you tripped over a cash-printing fortress to chase garbage with better multiples. And Romine makes it worse for everyone else. Nvidia's next-gen platform is already in development. That means hyperscalers aren't just locked in now, they're locking in for 2026. You don't build that kind of roadmap with a vendor, you build it with a partner who controls the rails. And here's what makes the moat damn near bulletproof. No one can clone it. Not AMD, not Intel, not even the cloud giants. They don't have the developer ecosystem, they don't have the software layer, and they don't have the trust. The real moat isn't technical, it's structural. Nvidia turned infrastructure into lock-in, and the deeper customers go, the harder it is to leave. You don't switch highways when you're already flying in the fastest lane. Is this stock a good long-term investment? Most people ask if Nvidia will beat earnings again next quarter, if guidance is high enough, if the valuation is too stretched. None of that matters long-term. The real question is simple. Is this business getting stronger every quarter? Yes. Revenue is compounding, free cash flow is exploding, margins are still north of 70% while they're scaling a new architecture. But here's what makes it different. Customers aren't just buying chips, they're betting their infrastructure on Nvidia's stack. The longer they stay, the more locked in they get. That's not just product market fit, that's control. The bull case is obvious. Nvidia owns the rails. They have the software. They own the developer ecosystem. They're delivering product cycles 12 to 18 months ahead of everyone else. They don't just have demand, they have commitment, real contractual hyperscaler commitment. But let's talk about the bear case, the real one. Nvidia could execute perfectly and still get wrecked by a macro slowdown. AI buildouts are expensive. These aren't impulse buys. They're multi-year capital expenditure decisions. If the economy turns, even the best companies get budget cuts. Hyperscalers slow spending, governments delay projects, and when the cycle turns, cash flow dries up fast, even for the winners. A recession doesn't care how good your moat is. It just turns off the faucet. So where does that leave us? Nvidia has a working moat, a dominant position, and a playbook they're running with precision. But it's still a stock, and stocks carry risk. Anyone calling this risk-free is lying to you. And for full transparency, this isn't just a stock I talk about. It's my second largest position. I own almost 8,000 shares, not counting what's in ETFs I own. I'm not guessing, I'm invested with real capital, real conviction, and real skin in the game. This isn't hype, this is discipline. The reality is you don't get many companies like this. A product lead, locked-in customers, multi-year visibility, cash compounding at speed, a moat that actually works, not in theory, in practice. Yes, it's priced for perfection. Yes, the market knows it's dominant. That doesn't mean the opportunity is gone. Here's the real question. Is this business getting stronger every quarter? Yes. Are the numbers trending up across customers, contracts, revenue, and cash flow? Yes. Is the product becoming harder to compete with? Absolutely. That's where real conviction belongs. This is not a cheap stock, and it shouldn't be. You don't get dominance at a discount. This might be the rarest kind of setup you'll ever see. A monopoly you can still buy while it's scaling. My thesis is bullish with full awareness of the risk. A recession can slow this down. A liquidity crunch can punish the multiple. None of that changes the core. Nvidia has the positioning, execution, and roadmap to keep dominating. But if you're expecting a smooth ride, you're in the wrong game. Because once-in-a-generation businesses don't come around often. And when they do, most people are too scared to own them. I'm not. Are you? Now let me ask you something. Who else is breaking down Nvidia's lock-in strategy, platform roadmap, and gross margin stack while actually showing you how to build real positions with real discipline? Who else gives you the bull and the bear case, ties it to macro cycles, and actually has money on the line? Nobody. That's why Nvidia is my second largest holding, and I'm not the only one winning. Wreaks Havoc, one of our moderators, just stacked back-to-back trades in Palantir, TQQQ, and SNDK. He doesn't guess, he doesn't gamble, he executes. And this is my actual account. I'm up 7 figures this year. No filters, no fluff, no cherry picking. I don't know another YouTuber or analyst that puts this much money where their mouth is. Inside my Patreon, you get real-time trade alerts. Every entry, every exit, every reason. Daily market breakdowns, only what matters, no filler, and my momentum system, the same one I use to scale 7-figure positions, and the most helpful, engaged, and intelligent investing community I've ever seen. It's $30 a month. Instead of blowing that on bullshit, put $30 into something that actually makes you better. If it doesn't 3x your investment in yourself, cancel anytime. No questions, no pressure. Most of my members stay because it keeps them growing, and it keeps making them money. The real question is this. Are you ready to stop watching other people win and finally become one of the success stories I feature? Because the truth is simple. You can scroll or you can scale, but either way, don't say you didn't have the chance to join.